Welcome to Lyra. I'm Chamin Tarangala, BSc graduate in Financial Management, and it's a pleasure to connect with you again through another valuable presentation. In this ongoing series, I hope you will grasp the concept from my previous videos and ready to move forward to gain even more insights in today's lesson. Without further ado, let's dive into the topic. Make sure to stay with me until the end of this video, as every detail is crucial in identifying the best opportunities to enter and exit the trade in crypto, forex, currency trading and stocks. Today I am bringing you a powerful tool, the Relative Strength Index (RSI). This widely recognized indicator, introduced in 1978 by J. Wales Wilder. Since the RSI indicator is available on nearly every trading platform, I won't spend time explaining its formulas. Instead, we will focus on mastering its use for generating entries and exit signals effectively. The Relative Strength Index is designed to measure momentum, which combines the speed and the magnitude of price changes. Many investors rely on this indicator to identify overbought and oversold levels, helping them to make well-timed trading decisions. The Relative Strength Index is displayed as a graph with values oscillating between 0 to 100. Now I am taking the graph to your screen. Please go through it very carefully. You can identify two levels, 0 level and 100 level. And stay tuned as I break down its practical applications and show you how to harness its full potential in your trading strategy. There are two critical ranges to watch closely. Overbought level. This occurs when RSI rises above 70. At this level, the asset is considered overbought, which may indicate that the price is due for a correction or reversal. It is a signal that upward momentum could be losing strength. The second level, oversold level. This happens when RSI drops below 30. At this level, the asset is considered oversold, which may suggest that the price is undervalued and due for bounce back or reversal. It signals that the down momentum could be weakening. To make you more clear, I have highlighted overbought level by this graph, and in the second graph I have highlighted oversold level. Many traders use RSI as a simple tool to buy when it's oversold and sell when it's overbought. If that is your approach, you are leaving a lot on the table. RSI is far more powerful when used to gauge the strength or weakness of price momentum. The word relative in RSI is where the magic happens, and the complexities too. RSI doesn't just show levels, it helps us to measure how strong or weak price movement are over time. This opens the door to deeper insights like confirming trends or spotting divergences. RSI is a tool for confirmation, not just signals. Spotting divergence when RSI moves opposite to price is one way to anticipate potential reversal, and confirmation trends ensure you stay aligned with the market momentum. Mastery takes time. RSI is a subject that involves with your understanding. The more you study, the more value you will unlock. RSI is more than meet the eye. Don't stop at overbought or oversold. Dive deeper, master the tool, and let it transform your trading strategy. If you are ready to take next step and I will guide you through the journey. Understanding the overbought and oversold levels of RSI. While many traders fall for false signals, I will show you how to spot the real trend and avoid costly mistakes. Most traders think overbought means sell and oversold means buy. Sounds simple, right? But this oversimplified approach leads to loss and potential failure. Why? Because RSI signals can be misleading in isolation. Confluence is important here. Overbought doesn't always mean a price drop in coming, and oversold doesn't guarantee a bounce. In strong trends, RSI can stay overbought or oversold for extended periods, and jumping into too soon can be a costly mistake. Here, I will show you this type of incidents one by one in my practical charts. Let's look at some real world example. Here, you see a classic overbought signal, but instead of reversing, the trend continues upward, and here's an overbought level where traders jump into soon, only to face further losses. Understand this nuisance is the key to strategic trading. RSI is a powerful tool, but only if used strategically. Don't rely solely on overbought and oversold levels. Look deeper, analyze trends, and make smarter decisions. Stick around for next lesson as we continue mastering RSI. Subscribe and hit the bell icon to stay updated. Today, I am here to turn the overbought and oversold levels into profit opportunities. Many think these levels are automatic buy or sell signals, but they are not. To succeed, we need confluence. Combining tools like moving average, oscillators, divergences, and market structures. Let's focus on pairing all awesome oscillator with RSI to create strategic entry points. As I have told you earlier, the common mistake is placing orders at oversold and overbought positions, thinking an immediate reversal. By sticking to a word overbought or oversold, but it in most cases expected doesn't work, making you a loss. I have taken several examples to prove the scenario. I am taking this as the first overbought position. It's very clearly highlighted. Here, see what is happening. It's in overbought position, but a continuous upward trend in the price. The second is also the same scenario. Third, I am taking prove you the same. Now I am taking you to a oversold position in RSI. In most cases, people place their orders thinking of a reversal. But here, the trend continues to downward, though it's in an oversold position. I am taking another scenario. See, in this oversold position, in the RSI, the price is continuing a downtrend. If you place an order thinking of a reversal, but it doesn't work, so taking decisions in isolated RSI you can't rely on. So why you fail further? I have a secret in my hand. The secret is confluence. Then I add awesome oscillator to the chart. Just by adding awesome oscillator to the chart doesn't say anything. So we have to adhere to some rules. There are two rules. Now I am taking rules one by one. But there's only two rules. Now I am taking the first rule. In first rule, first condition, the 14 period RSI must be above the overbought level, typically 70. The second condition, wait for the RSI to head down and cross below the 70 level. Then third, check the oscillator. It should start converting to red histograms. Fourth, the moment the first red histogram appears, place your selling order. Now, I take few charts to clarify this. In first chart, you can see overbought position. Here in this chart, you can see a confirmation overbought position and the converting histogram to red. In the RSI says overbought position and the RSI line is heading down. In the meantime, histogram is started to convert into red and you can place at the first point the selling order. Now I am taking the second rule. Here the 14 period RSI must be below the oversold level, typically 30. Then wait for the RSI to head up and cross above the 30 level. The oscillator histogram should start turning to green. When the first green histogram appears, place your buying order. Now I am taking a chart to confirm this. Now I have taken a chart to confirm what I said. Here RSI is at the oversold position and we can easily get the decision or place the order to buy as the conditions I have mentioned in the oscillator is fulfilled with this RSI level. So without any hesitation we can place the order. Now to place this order at the first green level is now okay and see what has happened. It's in a moving upward trend. So my proof is okay. By sticking to the steps you have already learned, you will position yourself ahead of others. Actually, RSI and oscillator are a powerful combo when used strategically. Overbought and oversold levels are just the start. True success lies in following rules and leveraging confluence. Stick to this method and you will rise above traders relying on outdated tactics. I will see you in the next lesson on divergence.